we're going to talk about the retirement vehicle for investing, and we're going to, Justin and David are going to talk to us about the different retirement vehicles out there and what they would recommend and what's the pros and cons of each of the retirement vehicles so you can make that best decision for yourself. I'm Kavita Bartake. Before I go on, disclaimer, I have to say that all this is educational. Please always consult before making any decisions. Please consult your attorney, financial advisor, and CPA for all legal matters and specific tax situations. We will talk about some tax situations here, but it is all specific. It's not specific to your situation. So always consult your attorney, financial advisor, and CPA. I won't get too much into my introduction. Most of you folks know me week to week. I'm a principal at Cherry Street. I come from a technology background and I've been doing real estate investments for over 10 years. Started with single family and now in multifamily. I'm an Aggie for those of you who are from College Station, hello. And those of you who are from Longhorns, we don't like you, but it's okay. I live in Austin. I love Austin. I own and manage rentals and also do multifamily investing, and I live in Austin. I have a teenage daughter and 2 puppies. About our guests, today we have David Morris. David has always had a passion for investing and entrepreneurship. He received his degree from business administration and also spent almost his entire life in the financial industry, from the bond market world to the retirement investment world. He founded and continues to own one of the most successful fitness centers in the Birmingham metro area. David and his wife, Hannah, have 3 kids, and when he's not working, he loves spending time with his family. He's the National Director of Total Control Financial. Our next guest, Justin Palmore, is originally from a small town in South Alabama, where the principles of hard work and perseverance were instilled in him from a very young age. He received his bachelor's degree from Samford University in Birmingham and his master's degree from Vanderbilt University in Nashville, Tennessee. From human resources, the nonprofit world, and the medical industry, Justin has honed his skill set and passionately desires to make a positive difference to those around him. He and his wife, Emily, have 3 kids, and he loves nothing more than being with his family and doing fun outdoor activities with them. Justin is the National Director of Syndicators for Total Control Financial. With that, I'm going to hand it over to David and Justin. Take it away.
Hey everyone, like she said, my name is Justin Palmore, and David Morris is on here as well. We are so happy and honored and privileged to be with you here tonight. As Kavita said, David and I both have families with 3 kids, and we just absolutely love being able to put them to bed and jump on these things with you guys, because we know that y'all are working hard during the day, and we are as well. And it's just an honor and privilege to get on here and help educate. Our goal here tonight is not to be salesy. While we do have a product that we will talk about, it is in no means to be a product sales. Our goal really is to educate. And as the National Director of Syndicators, I talk to syndicators every day. It is my passion to educate and to educate people to make the right decisions and to make the best decision for them. And so we're going to talk about retirement vehicles, different retirement vehicles for investing, and we want you to be able to make an educated and responsible decision. So with that being said, we'll go ahead and get started. So why are we talking about retirement? Why are we talking about retirement vehicles? The reason why this is so important is because there's approximately $30 trillion out there in retirement money. 30 trillion. It's a lot of money, and it's a lot of times it just sits there in people's old 401ks or old IRAs or old 403bs, you name it. A lot of times it just sits there and does nothing. So we need to be growing our retirement money and really putting that towards the future and even into the present. So get to the next one. So like I said, we work for Total Control Financial. The eQRP is our go-to product, but our mission, our passion is just to break financial bondage, one shackle at a time. We've seen people get tied down in the system and in the market and lose it all. I mean, we all remember the recession, and a lot of people were tied down by the system at that moment and didn't have full financial freedom to invest in what they wanted to. And so it is my passion and David's passion. We are fervent about this, that we want to help break financial bondage and give you the freedom to invest in what you would like to invest in. So tonight we will be covering basically all the vehicles. We will talk about IRAs and SDIRAs. We will talk about 401k, and we'll talk about the solo K option. And then we'll finish with the eQRP, and we'll give some examples of syndications and flips used with these vehicles. And you can see kind of how the outcome is compared and see the financial results from that. So with that being said, again, I want you to hear my heart. It's such an honor to be with you tonight. Kavita is an all-star. We know that you're responsible people because you know her and you associate yourself with her, and we think the world of her. So she's in no way asked us to come on here and say, hey, talk about the eQRP. She asked us to come on here and educate her investors, and that's what we're here to do. So at the very end, we will have a Q&A session, and me and David will not jump off until all of your questions are answered. So I just want to make sure that is clear. And with that, I'm going to kick it to David.
All right. Yeah. Thanks, Justin. Appreciate that intro. Kavita, thank you for having us on. Like he said, it is absolutely our passion to educate. The basis of our company is to educate people, to empower them to be able to use their retirement money to invest the way they want to have full control of that, to better secure their future once they get to that retirement age. So the things we're going to talk about today are the IRA, 401k, and the eQRP, which is our product. So we'll kick it off. We'll talk about the IRA, individual retirement account. Most of you are probably very familiar in one way or another with an IRA. It's a good place to put money away for retirement. There are tax deferred and there are tax-free Roth options. Tax deferred is defined by the fact that you are putting money into the plan pre-tax. So you have not paid any income tax on that money. It goes into the plan. It is able to grow completely tax-free until you start pulling that money out at retirement age. And then when you pull it out at retirement, as you take distributions, you pay income tax on the amount of money that you pull out that calendar year. And you would pay that income tax at the current tax bracket that you're in. The Roth option is another great option. And the difference there is that you're actually putting in post-tax money. So post-tax meaning you've already paid income tax and you're putting that money into the Roth account. You can grow that money completely tax-free, and then also distributes to you at retirement age completely tax-free. And so there's a lot of pros and cons to both. There's always a lot of conversation around what's better, and the conversation typically is around, well, what tax bracket will you be in at retirement, et cetera. I think we're on the side where we believe that income tax rates are going to be going up over the rest of our lifetime. And then we also plan on also earning a lot of money inside of our accounts. So Roth to us seems like a better option, but everybody has kind of their different situation. And as Kavita said at the beginning, you should always consult your CPA to find out what's best for you. And then there's the SDIRA. The SDIRA is a great investment vehicle in the IRA world because you're able to actually pick the investments. And that gives you a little bit more control, right? So you can put that money into real estate, whereas in a regular IRA, you're not able to do that. In a regular IRA, it's going to be more like stocks, bonds, mutual funds, things like that in just the regular markets that people invest in. The SDIRA, you're going to be able to get more into the gold, the real estate, that types of things. So some cons with the IRAs. There's typically a lot of fees when you look at IRAs. IRAs are going to charge you transaction fees a lot of times, asset management fees a lot of times. There's this nasty tax called UBIT. We're going to get into that a little bit later. But it's definitely something that you want to pay attention to. Specifically for what we're talking about today is syndications in Kavita's world. UBIT is a very big deal, and it is way more impactful to the return of your retirement account than most people actually even know. There's a pretty low contribution limit in an IRA, typically around $6,000 depending on your age. You have a custodian, so you have to go through them to get things done. Basically seek their approval. That's typically a 2 to 3 week process to get anything done with the self-directed option. So self-directed sometimes can be slightly misleading because you get to direct where the money goes, but then you have to get approval to actually have that happen, and you have to wait on them to do it. So it does create much more slower of a turnaround rate on those decisions. And then if you earn too much money, you don't qualify to have Roth anymore. So you'd be stuck with a tax deferred option.
Yeah, I want to say that I've done a self-directed IRA option, and it just took forever to get the paperwork through for things, and that sort of delayed the funding of the deal in a lot of ways. So definitely agree with you there on custodian approval for everything and the delays there in that process.
Yeah, and, you know, in the real estate world, sometimes you need to be very agile. Deals can leave pretty quickly if you're not able to execute when you need to. So waiting 2 to 3 weeks could sometimes mean missing an entire deal. So next we will talk about the 401k. Okay, this is general 401k. It's a great option. It's typically going to be coming from an employer. And you know, you have also these tax deferred and tax-free options. The contribution limit is much higher. If you are under the age of 50, that contribution limit today is $19,000. If you're over the age of 50, that is 25. Just so that y'all know, next year that's going up by $500. So $19,500 for under 50. And then the catch-up also increases by $5,000, so it's actually going to $26,000 next year. So you do have a very high contribution limit, and then you get employer match. That's really important. Getting that employer match is kind of like free return on your money. And anytime you have an option to do that, we always say absolutely go after that and get the employer match at least for your 401k. Some of the cons. You have very limited options. Typically in a 401k, you're just going to be given a list of mutual funds that you can choose. Sometimes you have the ability to go and pick your own stocks and bonds. So you really just don't have a lot of control with that. It's generally risk-based. So if you're very risk intolerant, you're going to pick this fund. If you're super high risky, then you're going to pick this fund over here on the end, right? And then typically all that money is going to be in Wall Street types of funds, whether that's bonds, stocks, mutual funds, ETFs, REITs, whatever it may be. It's going to be Wall Street money, big money that can have a massive impact on the performance of that portfolio, and it's totally out of your control. And there's a lot of fees with 401ks, a ton of hidden fees with regular 401ks that you never really see. You're getting fees in the 401k, the mutual funds all have fees that you don't see. You're just going to see the net at the end of the day.
Yeah, so this is Justin. I come from the medical device world, and I had a 401k with a great match from my employer, but I didn't have any control in my investment. So basically I would go to this website and tell them how risk averse I was. And then basically I would get a statement every month. So zero control. Some people like that, but I am on the other end of the spectrum. I like to have control and know where my money is going. And then there was always kind of phantom fees as David was talking about. So it's a great option. I love the match. I always loved when match day came around, because that means more money into my 401k from the corporation. But if the market tanks, which all indications are pointing towards that in the next several years, then there goes your 401k. So it's just, you're at the mercy of Wall Street. So.
Yep. Yeah. I mean, that control is really key, especially, I have a feeling the audience that is here tonight really wants control and wants to be in control of how that money is invested so that they can maximize the return. So I feel like we're probably in pretty good company here tonight with that. So next is going to be the solo 401k. This is the 401k version for the self-employed individual. You're still going to get the investment diversity. You're going to have a much higher contribution limit than the IRA. So it's the same contribution limit as the corporate 401k plan. It's really very similar to that corporate 401k plan as far as rules go, but you're going to have a lot more control of how that money is invested in a solo 401k, and you have options like real estate and whatnot to invest in. The cons are really just the execution of this plan. There's a ton of paperwork on the front end, and there is not a whole lot of help. Basically, when you go to get a solo 401k, they're going to create some documents for you. They generally call themselves document providers, and they're just kind of maybe pat you on the butt, wish you good luck. There's not a lot of support after they create it for you. It's typically a fairly inexpensive option for self-managing your retirement account. You cannot have employees with a solo 401k. It is created for an individual who is self-employed. That could be a 1099 employee. That could be a business owner that has no employees. And within that solo 401k structure, you actually don't have full liability protection from judgment or bankruptcy. That's really important. I mean, you save your whole life trying to build up your retirement account, and then to find out that it doesn't have complete liability protection and that it could be a penetrable entity is really bad. And so you just want to make sure that you protect your retirement money from those two things. What is that worth, right? And then finally, we're going to come to the eQRP. This is our product, and maybe before we get started, I would like to point out the fact that the eQRP is in the solo 401k world. So it's going to be governed by the same rules as the solo 401k. What's going to be different about the eQRP in the solo 401k is kind of how we package that product, how we build the structure. So we're going to build a structure that is going to provide you with that complete liability protection. I mentioned that a minute ago. It's very important to note that the structure that we build does provide complete liability protection from bankruptcy and judgment. It's kind of it's a two-tiered, layered structure that we build. We could get into that maybe on a one-on-one call to get into the details. That I don't want to muddy the water of the conversation tonight. But it just wanted to point out the fact that the eQRP is in the same world. It's just going to be different from the structure. The fact that we can adapt this plan to meet the needs of a company that has employees. So if today you're one person, your company grows, and then you need to hire someone, well, we can actually adapt our plan to meet the needs of that. And the last thing that's going to be, most important is just the service that you get. We're going to be there with you the whole time to help you through the process of rolling your money over. If you're rolling an asset over, how do you do that? And we're going to be there to help you with that. So you do have total control. This is a checkbook control type account. You'll be able to write checks or wire funds just like you can out of your personal checking account. It is exempt from UBIT. Again, we're going to get into that into a minute, but it is a very significant item to talk about. There's no transaction fees. There's no investment fees. We're not going to charge you to manage your assets because we're not actually managing them. You are. You do have a $50,000 credit line built into this, and you can 10x your returns with unlimited debt. Some of the cons, well, it's really just one, and it's also the best thing about the QRP. The best thing about the QRP is that you have full control. That could also be the worst thing about the QRP is that you have full control, no one looking over your shoulder. If you need help with something or if you have a question, you're going to have to reach out to get that help. And if you're not really self-responsible, you could potentially get yourself into trouble and or get yourself put into a bad investment and lose your retirement money. So this eQRP, it does stand for the Enhanced Qualified Retirement Plan. And that's kind of for the reasons I talked about. So what is it? It is a checkbook for your retirement. You can invest anywhere fast with a checkbook access. You have no investment fees, full lawsuit protection, the 50K credit line, and then obviously you can lever up your investments to increase the return. What are your options to invest in? We have real estate, obviously, for flips and or syndications, or lots of other opportunities out there as well. global options. We have people investing all over the world with the eQRP. You can do private lending. You can be the bank, whether that's private lending or hard money lending, whatever it is. Tons of our clients are doing this and getting great results. You can buy and hold physical gold in your possession at your home in a safe. And then you can even invest in Bitcoin. I know it's a hot topic these days. It's kind of been up and down, but there are a lot of people that are investing in Bitcoin through the eQRP. And so I think, one of the hot topics here tonight is going to be, what does a self-directed IRA look like up against an eQRP? And the SDIRA, again, we have a slow custodian, right? We have to go through, get approval for our investments. We have to wait until them to approve it. And then 2 to 3 weeks later, we're going to get a check so we can make the investment that we've already vetted and already decided we want to invest in. If there is debt, you do get taxed. That's that UBIT. The contribution limit is $6,000 a year approximately. And if you make too much money, you cannot have a Roth. The eQRP is going to be fast because you are the trustee. You can have unlimited debt on your investments. You can contribute up to $56,000 a year or more. And then the Roth option, you have unlimited income there to continue qualifying for that Roth option. And so really, where does the rubber meet the road here, right? Let's look at a few examples. We're going to start with an example. This is a real deal. I do believe this was down in Texas. It's one of our clients that put this deal on. He's a syndicator, and this is exactly what the deal looked like. It was a $55 million purchase. They used $11 million in cash, so they raised $11 million through a syndication, and they got $44 million in debt. It's a very, very typical structure, regardless of the size. I mean, that's going to look very similar to most of the deals out there today. 5 years later, they had gotten $5.5 million in cash flow. They were able to sell that property for $90 million. So a fantastic deal. They had $35 million in total profit. Just absolutely knocked it out of the park. And so what happens now? So now we actually end up having a tax problem. That's where this UBIT, this UDFI UBIT comes into play with the SDIRA. You sell it for $90 million. You have $35 million in profit, and $28 million of that profit owes tax. Where that number comes from, the 28 million, is the portion of the profit that correlates to the levered percentage. So if it's a 70% LTV deal, then 70% of the profit would now own tax. So on a $100,000 profit, is 70% leveraged, $70,000 of that profit is now subject to this UBIT tax. In this situation, the UDFI triggered UBIT tax equals $9.8 million. That's a lot of money. With the eQRP, it's not subject to the UDFI triggered UBIT tax at all, so there's no tax. UBIT, UDFI is, again, the classification of the income. Unrelated debt financed income. It's the debt portion that matters. It's you're using debt to lever up the return of your investment inside of an IRA that's going to trigger UBIT, unrelated business income tax, and that's up to a 37% tax rate. That's
hey,
very,
David, why are IRAs subject to UBIT and eQRPs or the 401 world not? Why is that?
Yeah, that's a great question, and we actually get that question all the time. And it's because there's two different sets of IRS code that govern these products. The IRA has its own unique set of IRS code that governs it, that spells out the UDFI triggered UBIT. The 401k world, which is what the eQRP is in, so 401k is in, does not have that UDFI triggered UBIT in the code. So it simply just does not exist. So again, kind of continuing here, the $25 million profit for the SDIRA, solid profit, but it's terrible when you compare that to not paying any tax and getting to keep that $35 million. So the IRA investors pay that $9.8 million in taxes. eQRP investors pay zero.
Hey,
So
David,
let's look at,
so for our IRA users on the call. So that we can just pay that UBIT out of our IRAs, right?
Well, you can if you want to pay penalties and taxes. So that would be considered a distribution. So in reality, no, you can't. You actually have to pay that out of your pocket on your income tax return for this year. So if the profit was made in 2019, you're going to have to pay that UBIT tax on your tax return for that year.
Interesting. I didn't know that. I thought you could pay it from your IRA account.
You can't because it would be considered a distribution. If it's tax deferred, you're going to pay full income tax and the penalty on top of that.
Okay.
So it's double taxed. It also brings up another point too, is that you get taxed this year, UBIT. If it's tax deferred money, you pay tax again when you pull it out at retirement. If it's Roth, you've already paid tax on it. So you're paying tax on the money twice regardless. So it's not a 37% tax. It's more like a 60% or more tax. So it really enhances that point, right? It is I don't want to get too biased here, but for leverage transactions, an IRA is a terrible investment vehicle. There's no other way to really say that because of the tax. Let's look at another real life example. Flipping a house with an IRA. We had a client who flipped a house using a SDIRA. And actually, I just noticed that we don't have all of the details here. So basically what happened is they bought a house for $150,000. They put $50,000 of equity into the house to fix it up, make it nice and presentable and sellable, and then they sold it for $300,000, which again, that's a phenomenal flip. They were super proud of themselves until they got to the table with their CPA, and their CPA told them, hey, great job, but guess what? Now you owe $20,000 in taxes. And they said, what? What do you mean? We did this inside of our IRA. There is no tax. And goes, well, actually there is tax. It's called UBIT and you owe $20,000. So what's the solution? The solution is we actually converted that SDIRA to the eQRP, and they were able to actually sell that property, make the profit, and keep it all in their pocket instead of paying that tax.
So can you convert that after the fact? Let's say I have a gain and in 1 year, can you convert it the next year, or does it have to be in the same tax year?
So convert the gain or convert the investment?
The IRA to a eQRP.
So you have to convert it before the property sells.
Okay.
Yeah, and we're getting some, actually, Justin, just so you know, and we haven't really come up broadly with this yet because we're still getting clarification. There may be a way that if you catch it in the year of the gain, so if the property is already sold, but you realize what's happened before the end of the year, there may be a way to still convert, but we still needing to get clarification on that and exactly the mechanics of that. And that's definitely, we're going to use some high-level accountants to find out the real details for that.
Got it.
Mm-hmm. So again, the eQRP is exempt from the UDFI.
Hey, David, so we got a question here. Is there any tax liability when you take money out of the eQRP before or after retirement?
Yes, if you take it out before retirement, it's going to be the same thing, right? So you either have tax deferred money or you have Roth money. So both tax deferred and Roth are going to be an option inside the QRP. It's built into the system. And you can, in fact, you can have both. So you have one plan, and you could have an account that is tax deferred traditional, and you can have an account that is Roth. So there's just checking accounts, and so you can have multiple checking accounts within the plan. And it would be treated the same way as any other retirement account. So if you're pulling money out prior to retirement, if it's tax deferred, you're going to have to pay income tax plus penalty. If it's Roth, you're just going to have to pay penalty.
And I think I just want to clarify, I had this investor ask me this question recently as well. And in their mind, if they put money in a 401k or any retirement account, it would come out tax-free when they hit retirement age. And I'm like, no, it doesn't. You still pay taxes. Right. You just defer the taxes until retirement. What you don't pay is after retirement age is 59 and a half, you don't pay the penalty, but you still owe the taxes. And the bet we all make is that we will be in the lower income tax bracket at retirement than we will be right now. But that's not always true unless you want to retire poor.
That's right. Well, and that's why the Roth option is so powerful, right? I mean, we do believe that a Roth QRP is probably one of the most powerful tools out there for wealth generation, because you can put, you can contribute money into the plan. So you contribute $100,000 into the plan, and you're able to multiply that times 10. You turn that $100,000 into $1 million over 20 years. That's really not that far-fetched to think that you could do that, especially when you're looking at syndications. If you invest well and the syndications go well, that's very feasible to do within 20 years. And in a Roth, if you've contributed $100,000, you paid your income tax on the 100 up front, you have the $100,000 in the plan, you just made $900,000 more over your lifetime. And then when you pull that money out, you don't ever pay any taxes on it at all. So you essentially made $900,000 more and you never paid any tax. The other thing that's great about that is that you can pass on a Roth QRP to your descendants, and they can inherit it as Roth. They can also use it today, not when they turn 59 and a half, they can use it today no matter how old they are, by dispersing those funds completely tax-free. They continue to grow that plan completely tax-free as well. So it's extremely powerful. So I'm glad you brought that up. Another thing that's really important to know here is that, this question comes up a lot. Already invested in a deal with a self-directed IRA, like a syndication that has debt. This UBIT tax is imminent. It's absolutely going to happen. Well, what do? It's called an in-kind rollover. So you already invested in that syndication in your self-directed IRA. You found out about the tax. You come to us and you set up an eQRP, and we help you roll that over and in kind. Oops, that didn't work. So it's an in-kind rollover. We're just simply moving that asset from the IRA to the QRP, changing the ownership from the custodian, FBO, the individual, and moving that to the QRP, which will be the first and last name of the individual. EPSP 401k will be the name of it, and we're just simply changing the ownership of that. There's a little bit of other paperwork. You have to go to the syndicator themselves and get the investor changed, or the LP name changed from the custodian to the new eQRP name, and the new account information, so they know where to send distributions. It's a little bit of work. It's really not that bad, and it's absolutely worth it when you think about how much money you're going to save in taxes. So who's qualified? Syndicators are qualified. Kavita, you're qualified. Congrats. Self-employed people. That includes an online business, whether that's Amazon, eBay. If you're a lady who does some of these beauty product sales, that counts. Investors, W-2 employees. If you have employees, your relatives, your kids, even grandma can qualify for this. It's not a big deal. The qualification is something that we can talk about one-on-one to figure out what your exact situation is and come up with a solution for you. So how do you fund it? Most of the people that come to us have a rollover already, an IRA, an old 401k, a TSP, a 403b, a 457, and you can roll that over into the QRP. And you can also do an unlimited number of direct rollovers. There and unlimited amounts, right? So there's no dollar limit. There's also no number of rollovers limit. So if you have 10 different accounts, you want to roll them all into the QRP over time, you can do that. If you have one account and you want to divide that into 2 or 3 different rollovers, you can do that too. Doesn't matter. There's no extra charge for that. Then there's also contributions. We talked about the high contribution limit, $56,000 plus per year, deferred or Roth, and there's no income limit for the Roth.
Are the contributions for the Roth same as the regular one?
Yes.
56, okay.
Mm-hmm. All right, everybody. So if you can take out your phone right now for me and text the number, text the word eQRP to the number 72,000, you will get our special report. So the special report is basically our white paper, and it's the nuts and bolts of Damien's book that he wrote regarding the eQRP and all the kind of rules and regulations and laws around IRAs and 401ks. This is the nuts and bolts version. It'll come straight to your phone, and it'll really kind of give you a broad brush idea about the eQRP, and it's really good. So if you can take your phone out, type eQRP to the number 72,000, that would be awesome. And then we are going to move into some questions. So David, I got a couple questions for you.
Yes.
Nathan is a W-2 employee, and he wants to know what W-2, you said W-2 employees, are qualified, so how does that work?
Well, I mean, it just depends on what you have going on outside of your W-2 job. That's where, a good conversation would come in to really fully understand everything that you're doing. If you have some rentals and you're managing those yourself, that would count. Like I said, if you have Amazon online business, that would count. eBay, really anything. I mean, all the IRS says is that you have to be a business owner. It does not further define what that means. So, I mean, a lemonade stand is a business, right? I mean, and we can all agree that if you have a product and you're selling it for return, then that is a business. So, I mean, it can take on so many different forms. It's really hard to kind of drill down unless we dig into your specific situation. But I definitely appreciate the question. I would love to jump on a phone call to dig into your specific situation and figure out how you do, or we can get you to qualify.
So
Awesome.
you usually help people who don't already, let's say, can't think of a business or something. You actually help them, kind of guide them to set up a business and then set up a QRP based on that.
That's right. We can help formulate an actual business.
Okay.
All right. And then our next question, David, is how long does it take to set up an eQRP? This is an important question, especially. So Kavita calls her investor group and she says, I've got a deal and it's going to close right now and I need funding. So how long would it take to set up an eQRP? And then after that, the question that everybody's wondering, what are the fees for a QRP?
Yeah, so how long? It's actually really quick, and it depends on your situation. Again, if we need to move now because you have a deal closing next week, we can turn around all the paperwork inside of a day. Typically, if it's not that urgent, it's going to take a couple of days to get the documents produced to you in a DocuSign document so you can sign them. We got to get the checking account open. We can push that through and get that done same day if need be. Otherwise, it takes a couple of days, and then the rollover process. And that's going to depend on how responsive your current custodian or 401k provider is. Typically, it takes inside of 2 weeks.
Yeah, and I've seen most of the time it's the rollover custodian who's the culprit. They take forever, especially Fidelity or Vanguard. So that is probably the longest part of your process and not the actual eQRP setup.
For sure. And the great thing is we talk to a lot of these people all the time. I mean, we roll over money out of Fidelity several times every week. I mean, I think it's probably 3 to 5 different plans a week from Fidelity. So I could tell you exactly what's going to happen there. We just have a lot of experience with most of the larger providers out there, a lot of the main SDIRA providers we deal with all the time. And so typically it is a lingo problem. When you call and you're not using the proper lingo, they think you're trying to do something else, muddies the water. As soon as you have a problem, we encourage our clients to just call. Just give us a call. If you're on the phone with your IRA or 401k provider and they're giving you pushback, patch us in. We want to be on the phone and help make that an easy process.
So Dave, the next one is QXQ Properties. They say I am under contract to sell a property with a mortgage, or I'm in contract to sell a property with a mortgage. Can I move this property into the eQRP to avoid capital gains?
I'm sorry. So is the property already inside of a plan? I didn't catch that.
I don't think, it sounds like the property is outside of a retirement account.
Got it.
Sounds like the person wants to move the property into a retirement account into an eQRP to avoid the gains.
Yeah, no, unfortunately you can't do that. That would be called something that's called self-dealing. It's strictly prohibited, unfortunately. That would be putting a property or an asset that you already own into a tax shelter post-purchase, and that's not allowed.
And I think there's another question from QXQ also about, you made a distinction earlier between solo 401k and eQRP, but not really. I have a self-directed solo 401k. Isn't that a QRP?
Well, yeah, I mean, a QRP in general is a generic term for a qualified retirement plan. The eQRP is where it's different. That's going to be the liability protection that we build into the structure of the product that we build. The ability to grow our product to meet the needs of the safe harbor laws. So the safe harbor laws are the laws that protect employees from their business owners taking a benefit out of the business that they're not also offering their employees. And we can actually adapt our plan to meet the needs of that. And then it's the support. That's huge. Document providers that do nothing for you after the fact don't really do anything other than provide a document. And if you don't know the rules surrounding retirement plans, you could potentially get yourself into a lot of trouble. So it's very important to have a team of people like ours around you that can answer your questions at any time that you have them, to keep yourself out of trouble, make sure you're documenting things correctly, make sure you're not acting in a way that you shouldn't that's going to get you disqualified or getting yourself into a disqualified transaction altogether. Because if you do, it disqualifies the entire plan, and the IRS is going to take about 60% of it and force you to liquidate everything that you have in there.
Yeah, I want to add to what David just said. I think the solo 401k has its merits, but it's not great for people who don't want to get into the nitty-gritties. It does give you control, but too much control can sometimes be a bad thing if you don't know what the legal transactions are and what's not legal to do with your 401k. So I think that's where I think the guardrails around eQRP are better, because Bravid and team kind of help you through the process and make sure that you don't commit any, get into any transactions which are not legal for your solo 401k or your eQRP to do from a legal or IRS perspective.
Yep. You know, and the one thing about that is too, is that you do have to reach out to us to ask us questions. We're not going to know what you're doing unless you tell us. I think that's really important to point that out. We're not going to be looking over your shoulder to make sure you're doing it right, but we're going to be there for you whenever you need us. I want to just make sure we make that distinction.
Yeah, good point.
All right. So, David, what are the terms, restrictions of the 50K line of credit?
Yeah, so the $50,000 line of credit it's a 401k loan. You can get it from your 401k that you have at your job, but it's up to a $50,000 max, or 50% of the asset value of the plan. So if you had $100,000, you can get all 50. If you have $90,000, you have $45,000 of available credit line. And then again, if you had $500,000, you still only have 50 that you can do. You have to pay that back within 5 years. It has to be a fully amortizing loan that you make at least quarterly payments. So it's going to be monthly or quarterly at the least frequent. And you have to pay yourself back with a normal interest rate. It's a super wonderful, vague comment by the IRS, normal. But we interpret that to be, you know, any justifiable rate. Prime plus 1 is a very good example of normal in our opinion.
Awesome.
So Nathan asks, if you max 401k, the work 401k and a traditional IRA, are you eligible for eQRP?
If you max it out, is that what the question was?
If you max your work 401k, your employer 401k and your traditional IRA, are you still eligible for QRP?
Absolutely eligible for it. Eligibility and contributing are two different things. So eligible is going to be tied to what you're doing as a business, whether that's W-2, some type of outside business, some type of self-employment, or owning your own business. That's where the qualification is going to come in. So contributing to a 401k plan, maxing it out, has no impact on your qualifications. And then again, also contributing and maxing out an IRA has nothing to do with contribution. Contributing to a work 401k does reduce the amount of money that is eligible to be contributed. So we have that 56K plus, depending on your age, that you can contribute to the plan. If you are maxing out your 401k at work, you're probably contributing $19,000 a year, which would leave an additional $37,000 that you could potentially contribute to the QRP.
I think it's also important, right, that your business should be making those contributions and you can't bring it from outside. So let's say I'm working and I have a business. Now, business is not making enough money. It's just a dummy business. I mean, I'm doing something, but I'm not making a ton of money. I can't really contribute from my W-2 job and the money from that job, right? It has to be coming from a business. But what I can do is really where it's useful is the rollover. Is that right?
Exactly. Yep. So if you have an outside business that qualifies you for the plan but doesn't make a lot of income, you're likely not going to have any income that you can contribute to the plan. And also, if you're making a ton of income but it's all tax advantaged in some way, so you're not going to be able to contribute. So basically, the reason I say that is to contribute to the plan, it has to be considered earned income, and all earned income is subject to Social Security tax. Most real estate income is not, so you would have to find a way to reclassify or pay yourself a fee to manage the portfolio, whatever. There's a lot of accounting kind of creative ways to do that, but the business that you have has to be the one that's creating the income in order for the money to be eligible. So you're right, Kavita.
All right, David, can a eQRP own an asset / house?
Yes, absolutely.
I think people are asking about the fees.
Yes.
Someone missed the fees.
I missed that earlier. So, sorry about that. Yeah, thanks for bringing that back up. Yeah, it's very, very straightforward fee structure for us. There's a one-time fee to set everything up. For that fee, we're going to build the plan. We're going to get the account established. We're going to help you roll everything into the new plan. We're also building an LLC in there. That's where that extra layer comes into. Again, I'm not going to get into too much detail there. I don't want to muddy the water with the conversation, but just know that it's there, and its purpose is to create a rock solid liability protected structure. We build all of that for $2,600. That's a one-time fee. If you are married and your spouse is in a similar situation with an IRA or 401k rollover, we actually waive that entire $2,600 fee for your spouse. So that's a great benefit for married couples. Then there is a $399 annual maintenance fee per plan. The $399, that is a flat fee. It doesn't matter how much money you have in the plan. Doesn't matter how many transactions that you make through it. It is a flat $399. And the $399 is going to cover a lot of things. It covers filing fees for the plan and the LLC. It covers the registered agent fee for the LLC. It pays to have the plan and the LLC stay up to date and in compliance on an ongoing basis. That's very important because when the rules change, your documents have to be changed or they'll be out of compliance with the IRS, and the IRS could come in and potentially disqualify the plan. And we do that for you behind the scenes. We also, the last and maybe as important as anything else is the support. So you have unlimited support from us, our team. Anybody that's going to get on the phone with you is going to be highly educated on this subject matter and be able to direct you in the right path. In the event that you're trying to do something that we totally disagree with, we don't feel comfortable answering the question because of situational reasons, what we're going to do is we're going to refer you to one of the professionals that we can refer people to. And so that's it, $2,600, $399, no other fees.
So David, can you share what a lot of our clients do about the plan expense reimbursement?
Oh yeah, great. Yes, thank you, Justin, for bringing that up. Plans are supposed to pay for their own expenses. So what that means is we don't manage money. So this is why this is important. We don't actually manage money. And so we couldn't just debit your account for the fees. So what we do is we do have to charge up front for that. But once we roll all the funds into the plan, so you have, maybe some real estate assets we're rolling over and then some cash that's going into the checking account. Once everything's rolled over, you simply just write yourself a check to pay yourself back. That is a tax and penalty free disbursement of funds, and it's called a plan expense reimbursement. So you don't actually have to feel that, almost $3,000 out of pocket.
So I think
Awesome.
something
Sorry.
that will be useful for folks to understand is that a QRP just looks like a bank account for you. As far as you're concerned, you just deposit the money in there and you can take it out and you can write checks and you pretty much have 100% control on the account.
Absolutely. And it operates exactly like your personal checking account. You'll have an app where you can do transactions. You can wire money online. You'll have a checkbook.
I
Hey,
think
David.
April has some more questions about the inherited IRA. Should she or he take it offline?
No, it's fine. I can answer that pretty quickly.
Yeah.
Inherited, so there's two types of accounts that cannot be moved out of the type of account that they already are. There is a inherited IRA is one of them. So an inherited IRA is the default. So when you inherit a retirement account, no matter what it is, whenever that person passes away and passes the account onto you, it automatically defaults to an inherited IRA. And because of that, it can never be anything but an inherited IRA. So you're free to invest that. You could put that in a self-directed IRA. Even there's some out there that you could have checkbook control, and you could have full control of that money, but you're still going to be subject to that UBIT tax inside of an inherited IRA. The other type of account that is not eligible to be rolled out of the type of account that it currently is a Roth IRA. So if you have a Roth IRA, it has to be a Roth IRA forever. It can't be anything else.
So unless you set it up, so you can't do a Roth IRA rollover to a Roth QRP or eQRP rollover. It has to be set up as a Roth QRP. Is that right?
Yeah, so I mean, it could be a Roth 401k, a Roth 403b, 457, any other type of Roth account is fine. So you can roll Roth money in as long as it's not a Roth IRA. For some reason, the way they wrote the guidelines around the Roth IRA program, they made it such that you couldn't change the type of account that it is.
Got it.
Hey, David, what if people still want to dabble in some stocks and bonds in the QRP?
Yeah, great question. It's super easy. Fidelity has a great account for that. It's called a non-prototype account. As a member or as a eQRP holder, you have a portal, and in that portal will be a lot of documents that you may need at some point, and one of those is an application for this account at Fidelity. And what's unique about it is that most brokerage firms, if they're going to manage retirement funds, they want to manage the whole plan, right? They want to have that plan in possession. They want to be in complete control of how it works. They want to earn all the fees from it. Whereas this account is simply an account that allows for the investment of retirement funds, even though Fidelity is not managing that plan itself. So you open the plan account in the name of the plan, and you move money from the checking account to the brokerage account with them, and you're able to invest in stocks and bonds that way. It's actually quite simple.
All right, David, what if, QXQ asks, what if I already have an LLC? What are the costs involved to incorporate into the eQRP?
So if you already have an LLC, it depends. I mean, is that LLC inside of an IRA as an asset of that IRA, or is this LLC a business that you have? Or is it maybe just an LLC that has really no purpose yet? If that's the case, well, if it is a business and it's not inside of an IRA, that's just yours. You can use it however you want to. You don't want to commingle retirement funds with actual business funds or personal funds. And so for that reason, those LLCs kind of have to stay where they are. The LLC from an IRA, we would simply just roll that asset. So that LLC may own some real estate assets, syndications, whatever. We would just roll the LLC ownership from the IRA to the QRP, but that doesn't change the price of the plan, if that was the question.
I have a question. So let's say I have funds in my QRP and I want to buy a house. Can I still leverage it so wouldn't it be commingling of funds if I use my name to leverage? Like obviously my IRA is not, or my QRP is not going to leverage it, but I'm going to get a loan out with my name and then invest the down payment with my QRP. Can I do that, or is that considered commingling of funds?
So what you're saying is that the down payment would come from the plan and that
Correct.
you would go out and get a loan?
Correct.
Yeah, no, you can't do that.
Okay.
You can make that transaction happen. So the way that works is you use the down payment, you go and get a non-recourse loan.
Mm-hmm.
And not everybody is familiar with what non-recourse means. What that means, recourse is you personally guaranteeing a loan. It's always like to talk about it in the sense of a business. So if XYZ business needs to go out and get a loan for a fleet of vehicles for their business, the bank will say, yes, Mr. Jones, will loan you that money for the vehicles for your business. However, we want you to personally guarantee it. So even though the business is the entity that is borrowing the money to purchase the vehicles, and they're going to own those vehicles, the bank wants the individual to pledge their guarantee, which means access to all of their assets, to also provide additional collateral for the loan. And so the personal guarantee is not allowed when you are getting a loan for retirement investments. So in this scenario that you're talking about, you want to use some money for your down payment on the property and go get a loan to make that investment actually happen. You go to a bank and get what's called a non-recourse loan. And what that means is they're just going to use the real estate collateral to justify the loan. So typically what's going to happen is the LTV percentage is going to go down. Whereas if it's a personal guarantee loan, you can go probably to 90, 95% sometimes LTV. With a non-recourse loan, that number is going to be more like 60 to 65% LTV.
So let's say in that situation, a partner is involved and they do the guarantee on the loan. Mm-hmm. In that case, are you still okay investing from your retirement funds?
Absolutely. Yep. Okay. As long as you are not personally guaranteeing that loan, you're good to go. It's the same thing with a syndication. So if you think about that, in a syndication, the LP is not signing on the loan, they're not guaranteeing anything, but there is a loan, and that loan most likely does have a personal guarantee on it from someone, but the fact that there is a personal guarantee doesn't matter as long as it's not you.
Yeah, we usually do non-recourse for apartments anyway, so yeah.
Oh yeah, great.
But yeah, we still don't allow, like, let's say I'm a sponsor on an investment, I cannot use my solo 401k or eQRP for investment into that deal.
That's right, because it has to be a passive investment for the plan.
Correct.
You can't be an active investor. So a general partner would be active. Yeah. LPs or limited partners are passive. So it's a perfect investment for a QRP.
David, can you speak? I see a question here. Can you tell us more about your company? How long have you been in business? How many clients do we have? What's the total assets? Are we asset holders? Go ahead.
Yeah. So no, we're not asset holders, but we have been around for a while. Damian Lupar, our founder, business partner, has been doing this for about 10 years. Our current business has been open for 5, almost 6 years. And we have close to 1,000 clients. And the number of assets, we always find out how much people are rolling over. And so we are estimating the number of assets that are in our plans are somewhere around $500 million.
Awesome. I think those are the questions. Are there any other questions? I think we answered all of them.
Yeah, there was a couple I sent to your email, David. So
okay, great.
And then Kevin, I wanted to talk about this for just 1 second. So we would love for you guys to not have to pay for the QRP book that Damian wrote. This is the hard copy book. You would have to pay for it if you went to Amazon, but we would love for you to get your free book. So just go to this website right in your bottom right of your screen and order it from Kavita, and you will get it for free. So we would love for you to have a copy, and you can also go to eqrp.co and set a call with David or myself. Set an appointment, and we can get into the nitty gritty and answer every single question you have. We would love to jump on calls with you and really work through your situation, because we know everybody has different circumstances, different investment strategies, situations. Sean, hey, David, real quick, is there so the question that the LP GP comment, that you just answered. Sean wanted to know if we do have an FAQ section on our website. Sean, is that question in there and answered, David? If it's not, Sean, we can absolutely email you that answer, the LPGP comment.
What was the question?
The difference in investment
As an LP or a GP.
as an LP or GP.
Yeah, it has to do with passive or active, right? So to invest any type of retirement funds, whether that's an IRA, 401k, an eQRP, a solo 401k, they always have to be passive or there would be a disqualified transaction. And so as a GP, you are an active investor. You're actively seeking investors. You're putting the deal together. You're probably working with attorneys. There's a lot of activity going on in order to make that happen. Whereas on the LP side, you're simply giving money to the investment. All you're doing is giving it and then expecting that you're going to get a return at the end of the day. You're not actually having to do anything to get that return other than just invest your money. So that's the difference.
Great. Do you guys have to say anything else before we wrap up?
No, we just thank you so much, Kavita, everybody for jumping on tonight on a Thursday night. I'm sure the weather in Austin is miserable. Just kidding. I'm sure it's awesome. But everybody who joined from all over the United States, we are so thankful for you. Whether or not you get an eQRP or not, essentially that's not as big a deal to us as that we were able to educate you and that we were able to just give you some nuggets of wisdom that you can dive deeper. And that's why we want to provide you this book for free. We really are thankful for you, and we hope that we can provide you with some financial freedom and provide your family and friends with some financial freedom so that you can go out and make a positive difference in the world. And that's what we're here for. So thank you so much.
Yep. Thank you guys so much.
I just want to say, Justin and David, thank you so much for your time, and thank you for putting all this presentation together and patiently answering all these questions. I really appreciate your time. I know it's taking time away from your families right now as well. So I'm really very appreciative of your time. So thank you again for coming on the call.
Absolutely our pleasure. Thank you so much.
All right. Thanks everyone for joining as well. You guys have a great evening. Bye-bye.
Bye-bye.